Hello, and welcome to today's webcast, Tariffs, Tightening, Trumponomics, Time to Reconsider Gold, sponsored by Sprott Asset Management. Today's live webcast has been accepted for one CFP, one CIMA, and one CFA CE credit. For questions on credit, please use the number on your console. A copy of today's presentation, as well as additional documents, can be found in the green folder at the bottom of your screen. We also have a brief survey, which can be accessed from the teal folder. Our speakers will be taken by their questions. Please type your question in the box to the right of the slides. We'll get to as many of your questions as possible. If you are interested in a one-on-one meeting with Sprott Asset Management, please click the blue one-on-one folder at the bottom of your screen and confirm the request. A replay of this webcast will be made available. Once available, all registrants will receive the replay information by email. And with that, I'd like to turn it over to our first speaker, Ed Coyne. He is the Executive Vice President for Sprott Asset Management. Ed?
Thank you, Stephanie, and good afternoon, everyone. My name is Ed Coyne. I am the Executive Vice President and Head of National Sales for Sprott Asset Management. With me today is one of our Senior Portfolio Managers, Trey Reich. For those that aren't familiar with Sprott, Sprott is a global asset manager providing investors with access to highly differentiated precious metals and real assets investment strategies, backed by over 3 decades of experience. At Sprott, we manage more than $10 billion in precious metals and real assets and offer best-in-class solutions in both physical trusts and ETFs. At Sprott, we actually offer 4 separate trusts and allow you to own physical bullion direct. We have our Sprott Physical Gold Trust, which trades on the New York Stock Exchange under the ticker symbol PHYS. We also offer a Silver Trust with the ticker symbol PSLV and a Platinum Palladium Trust with the ticker symbol SPPP. In addition, we have 2 factor-based ETFs focusing on senior and junior precious metals equities with the ticker symbols SGDM, which is our senior mining ETF, or think about that in terms of larger cap miners. And we have a junior mining ETF with the ticker symbol SGDJ, which focuses on smaller to more micro-cap mining companies. In addition, we have a suite of public and private solutions in both the equity and credit market. More recently, Sprott acquired the Central Fund of Canada with the ticker symbol CEF, which adds a 4th physical solution, allowing investors to own both gold and silver in a single investment. The Sprott Physical Gold and Silver Trust started trading on the New York Stock Exchange ARCA on January 16th of this year, 2018. And with that, I want to dive into today's webcast. You know, Trey, despite the soaring equity markets and the higher interest rates, gold bullion has quietly gained over 23% in the past 2 years. And in today's webcast, I'd like to explore how an investment in gold can potentially enhance an overall portfolio diversification in a changing market environment. So with that in mind, Trey, in your mind, where does the gold trade stand?
Thanks, Ed. Gold is an interesting topic because there are so many investment cues shared by so many different groups of investors that buy gold for different reasons over different periods of time. And in the current environment, as we head into 2018, we've just left one of the lowest volatility stretches, certainly for U.S. equities, literally in history. So there are a lot of folks who at this point are thinking, well, stocks are at new highs. We seem to have synchronized global growth. The U.S. is in pretty good shape. We got a whole new set of tax cuts. We have a business-friendly president. Why would you possibly need to think about adding gold to your portfolio at such a rosy juncture? And what's ironic is for somebody like me who has spent the past 17 years really studying gold markets and monetary variables, I see as many, potential threats or clouds on the horizon, as I have ever seen. And it's just a question about, perception. So if I were to start to list things that might make 2018 an interesting juncture to start to think about a gold exposure in a portfolio, I would list the items on page 4. So U.S. debt levels, and it's fairly well chronicled. I think we all read so much about debt that sometimes we're inured into whether or not it matters anymore. But U.S. debt levels and the Fed Z1 report came out this past week through the end of 2017 are now at 69 trillion, and underlying GDP is about 19.7. Now, there are a lot of things of which I'm unsure, but one of the things that I'm pretty sure of is that you can't keep increasing, credit and claims and equity claims and debt claims and household net worth, 4 or 5 times faster than output forever. So at some point, that 20 trillion worth of GDP has to be, reacclimated to some amount of debt on top of it that can be effectively serviced. And we continue to head in the wrong direction in that regard. So that's the big backdrop, is debt and its continued growth, really untethered by underlying productive output. That's the biggest point, really, I think, of the presentation. If we look into specifics of what's going on in 2017 and 18, we have just left this low volatility era for the VIX, for whatever measure you want to use. But clearly in early February, with 2,000-point down days on the Dow in a 4-day period, I think it's fair to say that era has ended. It's possible that we enter a new era of low volatility, but for the time being, the one thing we know for sure is that volatility is back on the map. 10-year Treasury yields in mid-January broke a 35-year downtrend, and that's obviously one of the reasons that led to the volatility in equity markets. But that's a pretty big event. In the past 35 years, any backup in rates has caused pretty immediate financial stress, and we'll talk about that in a minute. Fed rate hikes, of which we've had 5 in the current tightening cycle, I'll give some evidence, have already led to increased consumer stress in many areas. Point being there that if the Fed were to continue to increase rates, say through 2018, at the sort of telegraphed rate of 3 or 4 rate increases, it's our suspicion that that would lead to pretty pronounced consumer stress, which makes those rate hikes somewhat controversial. The U.S. fiscal position, which nobody was talking about 90 days ago, has all of a sudden deteriorated pretty rapidly in terms of the Trump tax cuts, et cetera, and their cost. The U.S. dollar, I think, has been a bit of a canary in the coal mine for the past 15 months. In 2017, the dollar index, the DXY dollar index, posted its worst year in 15, and it's off to a bit of a slump here in 2018. So one would wonder, why is the dollar so weak if things are so rosy? The Trump tariffs is just entering, the equation or the map, and obviously no one has any idea what this means yet, but it's, another source of uncertainty. And then finally we have a new Fed chairman, and the market has a fairly long history of testing incoming Fed chairman's resolve. So that would be the short list of variables or concerns that I would have heading into 2018, all of which, in my opinion, would favor a portfolio allocation to gold.
In trade, there's a great chart that you always like to really start a lot of your conversations about gold, and that's really on page 5, the gold investment thesis about default or debase. Spend a few minutes walking us through that, if you would.
Sure. So I always start conversations about gold with sort of 3 observations. I've been doing this, as I said, for 17 years, and in that period, I've given thousands of presentations about gold, and I've learned 3 things over that time frame. In all of these presentations that I've given, I have never once convinced anyone to buy gold, simply because I was there or explaining the thesis. Gold is a personal type of assessment, and it has to come from within. And I really, therefore, want everyone on the call today to understand it's not that I'm proselytizing or expect to change anybody's mind. I'm just offering sort of a overarching viewpoint on how to interpret gold and its various implications for portfolio dynamics. The second thing I've learned is I've really never seen a topic that has most investors have an opinion with surprisingly strong conviction, generally without being burdened by intense understanding of supporting fundamentals. So gold is an emotional topic, and most investors or money managers or brokers have an opinion, and it's usually held with a lot of conviction. Not sure where a lot of the inputs that lead people to their decisions come from, but I recognize that it's difficult to sway folks from their opinions. And then the third is that there's no investment asset I've ever been involved with that has so many different competing investment cues. So some people think gold's an inflation hedge, some people think it's a deflation hedge, some people see it as a risk on trade, some people, just as many, view it as a risk off holding, and in times of financial stress, some would favor a safe harbor of gold, but just as many, I guess, would favor the safe harbor of the U.S. dollar. And because there's an inverse correlation between dollar strength and gold weakness, believe it or not, that can lead to weakness in the gold price in times of financial stress. So my point in bringing all of this up with a page like number 5 on the screen is that over the past 17 years, there's really been no other global asset with such a consistent and strong positive performance as gold. And if we look at why gold has been up in 14 of the past 17 years, this sort of belies the knee-jerk type associations that many people associate with gold investments like inflation, deflation, etc. Because in this 17-year period, we've had a couple years where we had deflationary pressures like 2002 and 2009. We've had periods of inflationary pressures, such as when oil hit 150. We've had periods mostly of falling rates on both the long and the short end, but we have had periods of rising rates, such as June of 04 to June of 06, when the Fed, under Mr. Greenspan's tutelage, increased Fed funds at 17 consecutive meetings and quintupled the Fed funds rate from 1 to 5.25. And gold during that period was up, 86% at its peak. So my point is, we've had round trips in commodities and equities and different movements in interest rates, and even the exchange rates between the dollar and the euro have taken round trips. But gold is still up in 14 of the 17 years. So there must be something going on here that's a little bit more overarching than some of these short-term relationships. And my theory, or thought experiment, if you will, is that over the last 17 years, a certain amount of capital has migrated from the global financial asset pile, which is now about $280 trillion, to the investable gold pile, which is about $2.8 trillion. And that rate of migration, again, is one way to think about the gold trade. If we assume it's been, say, 0.1% over this time frame, leading to this steady, meticulous, methodical increase in the gold price, the whole gold thesis is not about Armageddon or Weimar Republic inflation or failure of the dollar. It's just about that rate of migration from the financial asset pile to the available stock of investable gold to increase from, say, 0.1% to 0.5%, because if 0.5% of 280 trillion, which is about 1.4 trillion, tries to find a home in a pile of investable gold that's about 2.8, obviously there'd be a pretty severe upward price dislocation. And I think that's really what the gold trade's all about.
And that really brings us to our first polling question. And the first question really is one about debt. What you talked about is really the primary reason why you want to think about gold in general. And the question is, what has the ratio of non-financial debt to GDP done since the financial crisis in the U.S.? And we have one of three options. Has it increased? Has non-financial debt decreased? Or has it remained the same? And on the polling question, we added in non-financial just to be clear on what we were making reference to. So please take a look at that. We're going to allow a few moments for the responses to come in, and then we will push to the next page with those responses. But again, what has the ratio of non-financial debt to GDP done since the financial crisis in the U.S.? Has it increased, decreased, or remained the same? And while we wait for these the first responses to come in, we'll take a break, and we'll see what the general view is on the market as it relates to non-financial debt.
So the point of this question really stems from the fact that I think most investors have a perception that since the financial crisis, the United States has been delevering. We read articles all the time about how attitudes towards credit card debt and leverage have changed, and that debt levels were being reduced throughout the economy. The answers are up here, and 87% picked increased, 8.3% picked decreased, and about 4.5% picked remained the same. Now, I sympathize with the majority here, the 87%, because the answer is a bit of a trick question, and that is, since the financial crisis, there has been some decrease in financial credit, which is the part of the economy that was, over-levered mortgages, Fannie Mae, a lot of financial companies, et cetera, that have, sort of gone away. So financial credit actually, which is sort of a double counting in the economy to begin with, has in fact declined. But the non-financial credit, which is what we added to the question, has stayed exactly the same. And there's been a little bit of a delevering on the consumer side, but it's been more than offset by an increase in governmental borrowing. So the point of this whole concept is that even though there is this wide perception that there has been a delevering going on in the United States, that really has not been the case. And on page 8, which is and non-financial credit growth were a major factor in the financial crisis, and yet we really haven't accomplished anything in bringing those levels of debt down. And that's extremely important. One might say, why does debt to GDP, what's the direct impact or bearing on the gold trade? And the answer is that debt, and in fact equity claims too, represent claims on future output. And when we have excess credit, non-financial credit and non-productive credit, in essence, those claims on future output only have two ways to be rebalanced towards the output itself. The first is default, a default wave, and of course the Fed would do everything in its power to avoid that. And the second option is debasement of those claims. And in essence, that's the path that the Fed is choosing in QE programs and in keeping interest rates near zero. Monetary debasement, more printing of money, is the Fed's preferred option to bringing the burden of these excess debt claims back into some sort of relation with underlying productive output. Now on page 8, just briefly, this is debt to GDP in the last 100 years, and it's generally been between 140 and 170%, except for the Depression on the left and the Greenspan-Bernanke-Yellen era on the right. And the point of this is that to bring the system back into balance, we still need about 20 trillion of that excess credit to either default or be debased to bring the system back into balance. So in that environment where you have the potential for a revaluation of financial claims, obviously gold plays a significant role in because of its non-correlating nature in protecting portfolio purchasing power.
And with all that debt, it's interesting to take a look at our second polling question, which is, in the new millennium, since 2001, gold bullion's cumulative return relative to the S&P has been what? Has gold bullion been better than the S&P? Has their performance been worse than the S&P? Or has it been about the same? And this is an interesting exercise to really go through and look at, because to Trey's point earlier, the idea of investing in gold relative to the S&P is foreign to many investors. And so looking at what it's done in the last, 17 plus years now, this is an interesting exercise to go through. So again, in the new millennium, since 2001, gold bullion's cumulative return relative to the S&P 500 index has been what? Better, worse, or about the same? And we'll wait a few moments here until the responses come in. Okay, starting to tally up right now. As soon as I get the final, we'll push it through. Okay, so what do we got, Trey?
So the poll results show 48%, or the leading group, thought the performance of gold was better than the S&P in the past 17 years, and then the other two categories were roughly split. About 24% suggested it might have been worse, and about 27% suggested it was probably roughly about the same. So this is one of my favorite series of returns, because I think most people are surprised to hear that for the past 17 years, the compound annual return of gold, which pays no dividend, has been 9.65%, leading to a compound return of almost 400% increase, which is significantly better than the S&P, which over the 17 years returned on a compounded basis 6.32%, and that's with reinvestment of dividends, leading to a cumulative return of about 205%. So gold has outperformed the S&P on a cumulative basis by roughly 2 to 1 for 17 years. And what's funny about that, that's a pretty long period of time, to me, for gold to still not enjoy a broader-based representation in most investment portfolios. When I look at the performance of the S&P over this past 17-year period, I'm especially taken by the following, which is, we've had two big corrections in the S&P since 2000. The first was 51%, and that was immediately following the internet bubble in March of 2000, or the end of that advance. And the second was 58%, and that was during the financial crisis, and commonly associated with the peak in real estate. What's interesting is that the 51 and 58% declines are frequently sort of rationalized by investors as occurring from obvious bubble peaks. In other words, when the S&P fell 51% starting in 2000, it was sort of reasonable rationalization or normalization of the excessive heights reached in the internet bubble in terms of equity valuations. And same with the real estate bubble in the sort of 2007-8 period. Well, what's interesting about that is, as you can see at the top right of this chart, if those levels were bubbles for tech and real estate, how would one describe where we are today? We're clearly in a different zip code entirely, and I would point out that this past year, a lot of the sentiment-induced increases in equity valuations have really sort of hit, hyper speed in terms of their underlying fundamentals. So if we look at the $5 trillion increase in the U.S. equity market since the election in late 2016, that's been accompanied, by an increase in GDP, which at about a 7-to-1 ratio. So in other words, the stock market has appreciated 7 times faster than GDP. If we look at corporate profits, the ratio is about 45. The stock market's up about 45 times the increase in corporate profits. And if we look at domestic corporate profits, the number jumps all the way to 90. So the increases that we've had in the stock markets from these already very elevated levels, to me, is on fairly thin ice in terms of underlying fundamentals. Now, a lot of this period in 2017 came from a truly unprecedented decline in volatility. And we've all read a lot of articles about the fact that the S&P in 2017 and early 18 put in its longest stretch uninterrupted by a 5% correction. It's about 404 trading days. But to put this in perspective, I sort of prefer this depiction on page 13. This lists the number of consecutive trading days without back-to-back corrections of 0.5%. So in essence, what this graph really measures is how many days in a row did the market not go down 2 days in a row? Because 0.5% is really not a big deal. And the answer is, 310 days. So we went 310 trading days in the period ending early January without the market declining, 0.5% in 2 days in a row, which, as you can see, is more than twice as many as has ever occurred all the way back to the 20s. So I'm just using this as sort of a measure of the stored force that this low volatility environment, has grown. And the reciprocal of that is on page 14. The graph that we were just looking at is looking back in time, but page 14 is the measure of one-day volatility spikes, in the VIX index. So again, the prior page just shows how long this was going on. It's sort of like a wound up rubber band in terms of the stored force of this low volatility environment. And when it snapped, obviously we got sort of the reciprocal movement, which was the largest one-day move on record for the VIX index. Now, a lot of this has been blamed on a few short vol funds, which have sort of met their demise quickly and all that type of thing. We would suggest that it's more representative of very, very important fundamentals in equity markets, which have yet, I think, to be rationalized, and that is things like passive investing and stock buybacks, etc. So I think that there's a lot more unwind to come in the future in reversing this period of historic lack of volatility.
And to shift gears a bit, let's go to the third polling question. And this is, having rising U.S. Treasury yields been historically positive or negative for the overall market? And the three answers are positive, negative, or not sure. So again, having rising U.S. Treasury yields been historically positive or negative for the overall market? And again, we'll wait a few moments for the responses to come in. And Trey, while we're waiting for that, I just want to address again the stored force. That's something that I think people got comfortable with, was the fact that there was no volatility in the market. I thought it was really interesting when the volatility started to pick back up, and more recently, when you look at the TV or on the radio every day today, it seems like 1% moves plus or minus are becoming common. It's just interesting to note that volatility is really certainly starting to pick up. And the question is this a short-term anomaly, or in your mind, is volatility back here to stay?
Yeah. So I think everything, works in cycles, and I think that low volatility environment certainly hid a lot of the ills that are out there in terms of overvaluation and excess debts, etc. And I think another thing is that a lot of the sort of algorithms and trading systems that have come into the fore in the past, 10 years are all looking at data, the most recent 10 years, that was very abnormal. So all of this QE and liquidity provision is sort of what all the algorithms and, artificial intelligence type of programs are used to, when in fact it was a very unusual period.
Yeah.
So there's a lot of interesting developments to come there. In results of this polling question, the largest category was those who felt that rising Treasury yields have a negative impact on the overall market. That was about 52%. Positive was 38%, and not sure was 10%. Now, my biggest question, I think, with the current psyche of the investment landscape is I don't understand why many investors and consensus actually believes that Treasury yields on the long end can rise without significant disruption to asset markets. And I use as the defense for that position this slide on page 17. This is a slide which merely shows 10-year Treasury yields since 1973. And after their peak in the 1980-81 time frame, we've had this 35-year bull market for bonds, and everybody knows that. What I think most people ignore is that over that 35-year period, every time that we've had a significant backup in rates, we've had a financial crisis almost immediately. So one would ask the question, why is that the case? And that goes back to our central theme here, that with this much debt in the system, 10-year Treasury yields and everything that's linked to them in terms of spreads, the system really can't take rising rates without that immediate response of a default wave. And so therefore, bonds have a tendency, it's sort of a modern irony of too much credit in the system. Interest rate backups have a tendency to be very short-lived. So I'm not sure what's going to be different this time. I do know that this little red circle at the bottom right of this chart highlights the breakout of 10-year yields from their 35-year downtrend in mid-January, and it only took 20 basis points to go from 2.6 to about 2.8, and we knocked a quick, 10-11% out of the S&P. So if this, I will make the claim or suggest, if this pattern of rising yields continues through, say, 3, 3.25, 3.5, I would expect similar effects to the valuation levels for financial assets. Another way to put this is for many, many years, equity investors have defended or rationalized high valuations by saying they reflect persistently low interest rates. That's you hear or see that all the time. Yes, stocks are expensive, but it's all rational because these valuation levels, PEs, etc., reflect an environment of persistently low interest rates. So the question is, if interest rates start to rise, how many equity investors will be willing to concede that these rising interest rates are pretty deleterious for the same valuations that they fostered over the past 10 years? Now, we've talked about rising rates on the long end, but just as importantly, our position is that rising rates on the short end, the Fed raising the Fed funds rate, will also lead to considerable consumer stress. Always reminding that we're talking about reasons that gold makes sense here in 2018. When the Fed started raising rates in December of 2015, and on page 18, you can see the maroonish line immediately started to trend up, and that is the amount that credit card companies were assessing balances, the interest rates charged by credit card companies. So obviously they start to move up pretty much in sync with Fed rate increases. I think it's probably surprising to many. The blue line represents seriously delinquent auto loans, and this just underlines how stretched many consumers are in the United States, but just increasing credit card interest rates, over this 2-year period has caused a lockstep surge in seriously delinquent auto loans. And this is just one example in the system of the type of impact that rising rates on the short end can have. Other examples would be mortgage delinquencies, which just exceeded 5% for only the fourth time in history in the fourth quarter. subprime auto loans are even worse than all credit scores. And I would even say just this week we had our third month in a row of negative retail sales, which is certainly a barometer of consumer strength. So our point here is on the long end we had the breakout of the 10-year, but on the short end these Fed fund hikes are already starting to ratchet up stress across many areas of consumer consumption.
And the stress can be reflected in other areas as well, which is what our fourth polling question is about. And the question really is, as interest rates rise, what do personal savings rates do? Do the savings rates increase? Do they decrease? Or do they stay the same? And this could pose a bit of a trick question, because you would think as interest rates rise, that's good for the savers. They get more for the money they save. So again, the question is, as interest rates rise, what do personal savings rates do? Do they increase? Do they decrease? Or do they stay the same? And this really, the next chart we'll talk about, it really is an extension of what Trey was just making reference to about the Fed rate hikes are already ratcheted up consumer stress. So when we wait, we'll wait a few moments for the polling questions to come in, our response to come in, and then we'll pivot to the next question or the next chart.
Mm-hmm. So the biggest group picked decrease, 52%, increase 31%, and stay the same 17%. The majority was correct here. With this much debt in the system, when interest rates rise, believe it or not, it's almost imperative that personal savings rates decline because of sort of the stretched nature of so many U.S. household budgets. So if we look at page 21, I'm actually surprised how immediate the pressure on savings rates translated from the beginning of Fed rate hikes in this cycle. So the first arrow in this chart, December 2015, that was the first time the Fed raised rates in 9.5 years. The prior rate was the prior increase was the June of 2004 initial rate hike from the Greenspan period, where the Fed raised rates 17 times in a row. So it had been 9.5 years, and in December 2015, the Fed took on its first hike. And by the way, it took about a year for the Fed to calm markets down enough to undertake the second rate hike. But the savings rate, the personal savings rate, was 5.8%, and today it's at 3.2. It had crashed all the way down to 2.4 in December. We had a little bit of a bump up here in January to 3.2. So to me, that's a pretty telling analysis of how much Fed rate hikes pressure, consumer comfort in terms of monthly budgets and the like. So one thing I'm sure of is, I guarantee you the Fed is hoping and praying, I guess I could say, that Trump tax cuts deliver their advertised increases in take-home pay so that credit cards are not a means of getting by as they are now for so many consumers. The other new, I think, sort of variable on the block in the last 90 days has been the U.S. fiscal position. I don't remember reading much about it at all last year. And all of a sudden, folks like Goldman Sachs, et cetera, are increasing their estimates for how many billions of dollars the Treasury will need to issue over the next, 12 months to 5 years to fund what the equity markets were celebrating in 2017 as Trumponomics, the more business-friendly aspects of our president's plan. So after the initial market sentiment surges, Trumponomics, I think, is now really taking its toll. We've all read that the cost of the 2017 tax cuts is now estimated about $1.5 trillion. The January 18 budget bill included $300 billion in increased spending, by the way, from a Republican Congress, which is a bit surprising, for over the next 2 years. The federal debt ceiling has been suspended again, this time through March of 2019, and the Office of Management and Budget now estimates the Treasury issuance will surge from $519 billion in fiscal 17 to $955 billion in the current fiscal year, and then average $1.1 trillion for each of the next 5 years. So this is a pretty startling development in a very short period of time, and I think Chinese officials clearly signaled their concerns by floating in early January the concept that China might curtail or halt its treasury purchases. This, of course, was denied or modified the next day by another group of Chinese officials who suggested this information could potentially be fake news. I've always seen that as sort of a direct jibe to President Trump, saying, hey, maybe we will, maybe we won't. But in the case of near priceless timing on top of all of this, the Fed still plans to be downsizing its balance sheet at an annual rate of $600 billion by year-end 2018. So all of a sudden, you know, the U.S. fiscal position of the U.S. or of the federal government is seriously in question. I think that explains why the dollar has been so weak now for 15 months. It is somewhat surprising that in a year that equity market volatility was as low as it was and U.S. equity averages were reaching new highs, the dollar posted its biggest decline, just under 10% in 15 years, and the beginning of this year has been similarly weak. So in my opinion, you know, the dollar has been reflecting a growing concern in currency markets which are generally a bit more forward-looking, I think, sometimes than equity markets.
That gets us to our fifth question, which is, how did gold respond in the last two Fed rate hike cycles? First one being in 2004 to 2006, and then the more recent one from 2015 to present. Did gold respond positively? Did gold respond negatively? Or was gold relatively flat? Again, you know, how did gold respond to the last two Fed rate hikes from 2004 to 2006 and 2015 to present? And this is something that, you know, we come across all the time. I think the dollar and the direction of interest rates, at least from a perception standpoint, weigh heavily on investors' minds when they're thinking about allocating to gold and gold equity. So what's been the response, Trey?
Interesting. 71% said positively, 19% said negatively, and 9.5% said flat. So I'm very proud of our audience because there is certainly a consensus view among many investors that somehow Fed rate hikes are inherently threatening to the gold price. And on page 26, we point out that during the 17 rate hikes of the Greenspan regime, gold actually rose during that period as much as 86%. And on the right side, even more fascinating, these are the incremental Fed rate hikes, December 2015, and then the December, March, June three-step, and then December 2017. And it's getting a little bit uncanny how on each rate hike in the current cycle, the gold price has a tendency to immediately start an upward trajectory. Now, there's a little bit of sell on the rumor, buy on the news here, but I think there may be, we're not sure exactly why this has happened, but I think there may be growing recognition that when the Fed hikes rates, people are less concerned about the rising opportunity cost of owning gold because it doesn't pay a dividend, and maybe a little concerned about the impact on these rate increases on both, you know, consumers and the fiscal position of the U.S. So on the next page, on page 27, I think anybody knows how the tariffs are going to take shape or impact things, but I figured a little levity would be as good a way to bring this variable into the equation. I'm not sure I can even figure out what tariffs will do at this point. I know that there's a lot of protectionism in other countries, but we seem to be handling it in a very heavy-handed manner. That'll be an interesting variable in the current year. And then the last sort of variable or wild card is the fact that obviously Chairman Powell just took over stewardship of the Fed. The market has a tendency to test incoming chairman, and so therefore the parallels to 87 are getting a little eerie. You know, Chairman Greenspan took over in August of 87. The market had done well. The Fed had increased rates about 137 basis points, and the prior year 10-year yields had backed up just as they are today, but it didn't seem to impact equity prices until it did. So I hope that Chairman Powell doesn't have the same experience as Chairman Greenspan, but it is interesting that on his first day on the job, the Dow fell 1,000 points. Welcome to your new position.
And our final polling question is, can an allocation to gold improve risk-adjusted portfolio returns? Yes, no, or not sure. And admittedly, this is a bit of a setup question, but it's nonetheless one that's worth exploring, because the idea that adding gold to a portfolio and thinking about it as really an alternative to other assets in a portfolio and helping balance out that risk-adjusted rate of return is an interesting thought or approach to how or why you would allocate to gold. So I am very happy to see the response on this one. So look like we have the right audience.
I'm hoping that 95% is not an indication that folks just want us to be quiet so we can end the call, but 95% thought that gold might improve risk-adjusted returns. And on page 31, and there's a million of these types of ways to look at this, risk frontiers, etc. We felt this was the most persuasive way to describe that with normal portfolio building blocks like cash and bonds and stocks, depending on your risk tolerance, and in this graph we give the full range of risk tolerance. On the left is a portfolio that's 20% equity and 80% fixed income, and on the right we have 80% equity, 20% fixed income, and everything in the middle. And it really doesn't matter what risk tolerance the portfolio is being managed for. At each level, an allocation to gold, which is in red at the bottom of this chart, ranging between 2% in the more conservative portfolio and all the way up to 9% in the portfolio that's 80% equities, obviously needing more gold to offset the volatility and risks of the higher equity component. But in each case, this allocation to gold, because of its non-correlating nature, has a tendency to preserve capital during drawdowns and increase risk-adjusted returns over time. I would add that slide talks about normal circumstances, and I would say that one could make the case that the 2018 environment is anything but normal, so you might even increase those percentages. And then the last slide that I have on page 32 is if we increase the number of portfolio components to include other alternative assets such as hedge funds and private equity, real estate, and commodities, does gold still prove or provide a role if other sophisticated alternative assets are included in the mix? And surprisingly, in this case, with an aggressive and a conservative portfolio risk tolerance assumed, coincidentally, the maximum or the appropriate optimal gold allocation to increase risk-adjusted returns is almost the same. It's about 3.5%, adding some fuel to the fire that any portfolio really managed for any risk tolerance in any period will do better on a risk-adjusted basis with about a 3, 4, 5% gold allocation.
Yeah, I always like to call it the 5% solution. It's a simple way to think about how to allocate to gold and gold equities. And that really brings us to the last section of the presentation, which is we've talked a lot about gold. We've talked a lot about the market. We've talked about a lot of the stress and of debt levels and so forth that are happening in the market. So how can one actually allocate to the space? And one of the unique things about Sprott is that we solely focus on precious metals and real assets. So we're really a specialist in one of the more challenging parts of the market out there. And at Sprott, we offer a full suite of physical and mining solutions. And as I mentioned at the beginning of the presentation or webcast today, we do offer 4 separate physical bullion trusts, our physical bullion solutions to allocate to the metals themselves. For those that want a one-stop shop, the Gold and Silver Trust, again with the ticker symbol CEF, in my mind is one of the most direct ways to get a full allocation to both gold and silver. For those that want to purely allocate to physical gold, the Physical Gold Trust with the ticker symbol PHYS is a very direct way to own the physical metal. And then the Silver Trust PSLV is a way to allocate directly to silver. We also offer a Platinum and Palladium Trust with the ticker symbol SPPP. In addition to vehicles that we offer in the physical side of the equation, we also offer two factor-based ETFs we think are important to consider when you're allocating to gold and silver equities, which is something more than just simply looking at the market cap. We offer, as mentioned earlier, the Sprott Gold Miners ETF with the ticker symbol SGDM, which focuses more on the mid to larger cap mining companies, and then the Sprott Junior Gold Miners ETF, which is SGDJ, which focuses on the mid to smaller or microcap type junior mining companies. On page 34, it's worth highlighting or pointing out some of the unique features to our physical bullion trust. They are all fully allocated to the physical metal. They are all redeemable for the physical metal. They remove counterparty risk and are stored in a trustworthy storage facility outside the banking system. And for non-corporate U.S. investors, they provide potential tax advantages and are treated as an asset, not as a collectible. For many of you, you know that the collectible tax is 28%. And for those that invest in assets, your long-term capital gain tax will be 15 or 20. And our trusts are taxed as assets, not as collectibles. They're also liquid and easy to buy and sell, and all trade on the New York Stock Exchange under the ticker symbols that we provide here on page 34. Shifting to the two mining ETFs again, the things that are unique about both of our mining ETFs, both SGDM, the senior mining ETF, and SGDJ, the junior mining ETF, are highlighted on page 36, which is the primary factors we use in selecting the securities and the weightings in the portfolio for both of those ETFs. And what we've done is we've looked at our active portfolios and found the common denominators in the stocks that were successful and what were the common themes in those names in the portfolio. And as it relates to the senior mining ETF, SGDM, we found that revenue growth and long-term debt to equity were two of the primary factors in having success in the senior mining space. And Trey, I would just ask you also, and this is beneficial for the audience, is why is it that revenue growth and long-term debt to equity are so important when you're looking at senior mining stocks?
Sure. So, in gold mining, which is a very difficult endeavor, it's probably one of the longest duration, prospects on the planet. Building a gold mine can take 15 years from first drilling to successful completion, and making the mine, which can be $1 billion, $2 billion in valuation, work profitably with challenges of gold appearing in the Earth's crust at about 3 parts per billion are obviously, very daunting. So it's important for gold miners to keep their balance sheet in good shape, because, gosh forbid, when the gold price backs off, it has a very outsized impact on the leverage of gold mining. So the two things that really get gold miners in trouble are too much debt when we have a back off in the gold price, and purchase of properties or ore bodies which just don't pan out in terms of their grade or productivity. So in two ways to look at gold miners and sort of separate the wheat from the chaff is to look for rising revenues, because in the gold mining business, if your revenues are going up, that means you are finding and selling more gold, and a healthy balance sheet, because if your balance sheet is in good shape, you can survive the inevitable declines in the gold price in the future. So those two variables, I think, are extremely important in identifying gold miners that one can hold over time.
And that's as it relates to the senior miners. And then in the junior mining ETF, the Sprott Junior Gold Miners ETF, SGDJ, in addition to revenue growth, which you've already talked about, Trey, we've also found over time that price momentum in junior mining stocks or small or microcap type companies matters as well. And Trey, maybe just highlight a little bit about why price momentum is so important when making reference to or considering junior mining stocks.
Mm-hmm. So I think the answer is more of a non-negative there, in the sense that junior mining stocks are frequently involved in bringing a new mine on life. So it could be an explorer or a developer, and in that sector of the market you don't have revenues, so they can't be measured. And the momentum of a junior miner speaks volumes about how the details are going with respect to development of the project. Is it on time? Is it meeting its hurdles, etc. So price momentum is an important indicator for the execution of the management team when there aren't revenues to measure.
And thank you, Trey. And that really concludes the formal part of our presentation. Before we go to the Q&A section, I'd like to remind you to visit Sprott.com to learn more about Sprott as a firm and look at the full suite of solutions we offer, both in the physical metal space as well as the junior and senior mining space from an equity standpoint. In addition, if you go to Sprott.com/insights, you can download the most recent white paper, Oopsie Daisy, Equity Market Stumble, in early February, authored by Trey Reich, our senior portfolio manager that you heard from today, and also see some of the past white papers Trey has penned and talked about the challenges in the market, the opportunities in the market, and how to view gold and gold equity when building out a diversified portfolio. So with that, I'll turn it back over to Stephanie for the Q&A session of the webcast.
Great. Thank you so much, Ed and Trey, for such an informative presentation. As a reminder, a copy of today's presentation, as well as additional documents, can be found in that green folder at the bottom of your screen. And we do appreciate your feedback. Please take a moment to fill out our very brief survey that's located in the teal folder. As Ed and Trey said, we are going to jump into Q&A. I want to thank everyone for those questions that have already been submitted. In the event that you have a question that you have not submitted as of yet, you can type it into the box to the right of the slide, and we're going to do our best to get to as many questions as possible. There have been quite a few that have come in so far, so thank you for those. Any questions that is not answered on today's webcast, a member of the Sprott Asset Management team will reach out to you directly. And then just one last reminder, we have that one-on-one meeting request located in the blue folder, also at the bottom of your screen, in case you'd like to have a conversation to further discuss the ideas that were covered during today's event. And so with that being said, let's go ahead and jump into our first question. Advisor is asking if you can discuss the miners versus the physical aspects in the current environment.
Sure. So the way I like to look at this is, for every investor and for every investment advisor representing investors, it's important that the first portion, say 20% of a gold allocation, be in physical bullion that is accessible in some way, to use a phrase that you can get your hands on. So coins are a good example of gold bullion that can be stored in lots of different places, from the home to a bank, etc. And the other positive about coins is that sovereign coins are recognized around the world. People know coin dealers, etc. Banks recognize them for what they are, and they're easily redeemable for currency literally around the globe. So, maybe 20% in an accessible portion. The next 50%, I think, makes sense in a bullion vehicle like the Sprott Physical Bullion Trust, because of its ease of acquisition and sale, and the fact that the Sprott Trust is eligible for long-term capital gain tax treatment, to us puts it in a category all by itself. You're not allowed to take as long-term capital gain tax treatment for bullion and other ETFs, competing ETFs. So that's an important feature. But the ease of having, an allocation in an equity portfolio and an IRA, et cetera, to gold bullion through the Sprott Physical Bullion Trust, I think solves a lot of problems or challenges. And then the last 25-30% makes sense for an equity allocation into gold miners because of the beta to bullion leverage that gold miners offer to a rising gold price. The problem with gold equities is that they are volatile, they're emotional, and they have large swings in terms of 2 to 3 year periods. The good news is that in the current environment, gold equities measured by almost every valuation metric are the cheapest they've been versus bullion in many decades. So looking at the average MPV, the price to MPV of the average intermediate to senior type producer, we were just looking at this morning, has hit new lows in terms of relative valuation. So from this point forward, if one were to assume that the gold price has set a pretty good floor here in the low 1300s, and any of the things we discussed today in terms of potential variables, negative developments on the horizon, one would assume that moving forward, gold equities are going to be a spectacular place to be in terms of the leverage they offer to a rising gold price.
Great, thank you so much. And to follow up on that discussion of gold bullion, an advisor is asking if you were bullish on gold bullion or also gold mining stocks, and if so, which type?
Mm-hmm. We are bullish on the sector from this point forward. So I think bullion and equities play different roles, slightly to different roles. Bullion offers the investor the option or the opportunity, the capability to remove at a moment's notice virtually unlimited amounts of capital from the financial system. So as an investor, if one is worried about the dollar or worried about central bank stewardship or worried about debt levels, gold offers the ability to take a large amount of capital outside the vagaries of current equity valuations or the financial system, and just as much flexibility to bring that capital back into the financial system when the investor chooses to do so. Equities offer a leverage, a proven, established, really 2 to 3 times leverage to movements in the gold price, but there are equity aspects to gold stocks. So there have been periods like 1996 to 2000 when the S&P and gold stocks were negatively correlated. And by the way, when the internet bubble peaked in 2000, gold stocks tripled from their bottom. We happen to be in a similar period, even though there have been intervening periods where equities and gold equities were correlated. Since about September of 2012, gold stocks have been under pressure, and the S&P, we all know that story, has continued to hit new highs. So the divergence between equities generally and gold equities specifically is as wide as it has been in, again, many decades. So one would assume that divergence is going to close in the favor of gold stocks. By the way, it was closing in 2016. The S&P sort of rolled over, and people may remember that from January 2016 to August, in the space of about 7.5 months, large cap gold miners were up over 100%, and smaller cap gold miners were up almost 200%, about 180%. So the two groups, were really closing that divergence between general equities and gold equities. I think it's fair to say that the election of President Trump and everything that brought with it in terms of market sentiment set that closing of the gap back a bit. And so the question remains, are we just going to continue upward with the S&P and gold stocks will continue to be out of favor, or is that wide divergence likely to close over the next 12 to 24 months, and you certainly know where my bet is.
Great, thank you. And this is a great segue into another question that an advisor has submitted, asking if you think that Trump is going to reboot the dollar.
Mm-hmm. So it's interesting. I'm sure everybody has been reading today about Larry Kudlow's ascension to the economic advisory role in the White House, and his great phrase is King Dollar. So Mr. Kudlow appears to be espousing the view that a strong dollar is in the U.S. best interest. Prior to his announcement, or the announcement of his joining the administration, every signal from the Trump administration was for a weaker dollar, including the sort of malapropped, worded statements from Treasury Secretary Mnuchin, I guess about a month ago, when he said, hey, a weak dollar really works in our best interest. He was chastised immediately by governments around the globe for competitive currency debasement, and even President Trump had to come out the next day and say, oh, no, we really believe. But if you look at everything that Trump is for, in terms of bringing the deficit down, et cetera, that all implies a weaker dollar. So I actually believe that that's one of the reasons the dollar was so weak in 2017, is that currency traders, espousal of those views with respect to reducing the deficit, et cetera, was not lost on the currency trading community. So when you say reboot the dollar, I'm not 100% sure what the questioner means by that, but my view is that the overwhelming preponderance of evidence is that the Trump administration favors a weaker dollar.
Okay, thank you. And I do want to acknowledge, I know we're a couple minutes over the top of the hour. We do have just a few more questions that we're trying to get to. If you have to drop to jump to another call, we understand, but we would love it if you can continue on with us for just a few more questions. The next question came in from an advisor, and they're asking, aside from the structure, are there any material differences between Sprott's ETFs and mutual funds that own gold?
Yeah, the primary difference, well, you think about a regular mutual fund where you have an active portfolio manager, I would argue that our Sprott ETFs are very similar to that type of approach, because we're looking at fundamental factors that have mattered over time. If you are comparing our ETFs to other ETFs out there, I think we're very different, because other ETFs are constructed by means of market cap. So simply the largest mining companies out there garner the heaviest weights in the portfolio. So, bigger means better in their mind when constructing those portfolios. And that's not necessarily the case, particularly because you're dealing with a finite asset such as gold, that as you dig up more of it, it's harder and more expensive to get more out of the ground, and you're effectively putting additional pressure on your balance sheet and taking on more debt and so forth. So larger companies aren't necessarily the best. So if you compare us to other ETFs, we think the factor-based approach is a much more common sense, thoughtful way to approach the mining space, whether you're talking about junior or seniors. If you're comparing us to other active managers, that's probably a better comparison, because that's the type of approach you're getting with our factor-based ETF, is you're getting a more thoughtful approach that is looking at the fundamentals of the balance sheet. They are looking at things like price momentum when you're talking about the junior mining stocks and so forth. So the factor-based approach in general is more of an active-like approach when it comes to different factors that have mattered over time, and factors that we've considered or looked at where we've had success in our own active portfolios. So the primary difference is us looking at factors that matter and weighting our portfolios that way relative to market cap weighted indexes. What I would also say to that is, because we are applying factors, our confidence level is much higher and our weightings are far greater. So our portfolios represent anywhere from 60 to 75% of the overall fund. So in the senior mining ETF, for example, in SGDM, the top 10 names are over 75% of the portfolio. And in our junior mining ETF, SGDJ, The top 10 represent about 60% of the portfolio. So they're much more concentrated because we're confident in the factors and their ability to drive returns over a full cycle.
Very good. Thank you. The next question is, how do you contrast gold with Bitcoin, which some see as having replaced gold as a hedge against flat currency?
I'm surprised it took that long for the first Bitcoin question. We certainly get a lot of Bitcoin questions. The way I would summarize this is that the original thought process behind Bitcoin and the original investment thesis behind folks who originally invested in Bitcoin was certainly similar to some of the motivating factors in gold investors, such as trying to get a little money out of the financial system and having a currency or store of value that is not subject to the vagaries of human nature and central bank stewardship and debasement and that type of thing. What happened along the way, I believe, last year was one of the most spectacularly successful speculative runs in history. I'm trying to put that in a positive tone. We've seen a lot of bubble type charts with the tulip and the Bitcoin and all that. People made a lot of money being out in front of this thing, and it obviously hit highs that no one really expected were possible, very quickly. During that period of the Bitcoin trading realm, I guess, it's pretty clear to me that the folks who were buying Bitcoin at 19,000, given the fact that it was a nickel, back in June of 2010, were not folks that were thinking about the Fed's balance sheet. Folks that think about the Fed's balance sheet and that type of thing have a tendency to be fairly conservative. And what I think we had was a spectacular speculative run. The things that I think make Bitcoin different from gold, just to highlight a few categories, people forget Bitcoin is totally in its infancy, and there was a period where Netscape was a 90% market share, de facto undisputed market-leading browser in an emerging technology called the Internet, and Netscape's nowhere to be found. Bitcoin is now the undisputed, market-leading crypto in an emerging technology called the blockchain, but it's way too early for a definitive evaluation of Bitcoin's long-term prospects. So that makes Bitcoin right from the get-go very different from gold, which has obviously been around and doing its thing for many thousands of years. So there's an immutability quotient too. Gold's gold. Bitcoin is a string of code generated by software protocols and cryptographic algorithms. Some would say it's immutable and can't be broken. I would say most people don't even understand, really what it is. And then we have, aspects like volatility. And even though gold can be volatile, everybody's very aware that Bitcoin can be frighteningly volatile. And then there are aspects like safety and trust. And my personal view is that even though the blockchain allows people to trade with each other Bitcoins on the Internet without knowing who each other are, I think it's very unlikely that there'll be an application that would involve large amounts of accumulated wealth for, say, a family office or an endowment or an institution until there is an introduction of some sort of oversight and regulation to bring that trust factor up. Of course, bringing in oversight will upset a large portion of the Bitcoin cadre, because the whole point is, peer-to-peer anonymity, etc. So there's a little bit of a conflict there, which I think needs to be resolved before Bitcoin will be, an effective store of value.
Great, thank you. And I think we have time for just one more question. An advisor was asking, the U.S. once made holding gold illegal and you had to turn it in. Do you think this is likely to happen again?
Yeah, so it's interesting in that debt to GDP chart we looked at earlier, back in the Depression when GDP fell 45%, the debt to GDP ratio spiked up to the high 200s, and in order to preserve sort of faith in the U.S. dollar, which at the time was linked to gold, FDR had to devalue the dollar 40% and outlaw private ownership of gold for reasons other than adornment for what turned out to be 41 years. It's important to remember that back then, the average citizen could go to a Federal Reserve Bank with dollars and ask for gold, at the $32 value. I do get this question a lot, especially overseas. The U.S. is the only country to ever outlaw ownership of gold. And the question is, since you did it once, do you think you might do it again? I think the answer is no, for lots of different reasons. Number one, the dollar isn't linked to gold anymore, so it wouldn't accomplish as much as it did back in the 30s. Number two, we don't have a lot of gold in the U.S. Compared to gold around the world. We used to. We had about 2/3 of the central bank gold, but a lot of that left the country in defending the gold window. And third, I really just think the financial system has gotten to the sophistication level, and with immediacy and internet and trading, it's really become a global phenomenon. And so what I always point out is if the government were to do something like that in the U.S., it would actually serve our purposes dually. Number one, the trust, the Sprott Physical Gold Trust, which is held at the Canadian Mint, would certainly be a preferred way to hold gold. And secondly, gold miners, because they're all over the world and not under the auspices of the U.S. government, would perform, I would think, admirably under such a development. So even though I think it's unlikely, it would really help in terms of the performance of the vehicles that we traffic in.
Wonderful. Thank you so much. And at this time, let's go ahead and wrap it up. I do want to thank you both, Ed and Trey, for such an interesting and informative presentation. And thank you to all those audience members who were able to join us today. We appreciate your time. If you do have additional questions, you can find both Ed and Trey's email on your screen in front of you. Please don't hesitate to reach out to them. And we thank you all so much for your time and hope you have a great rest of your afternoon.
Thanks.